Have you ever felt like you're just a monkey working tirelessly to earn leaves, only to find you can barely afford a single banana in what feels like a totally rigged system? Yeah, you're definitely not alone. Welcome to this explainer. Today, we're decoding the jungle economy right from the ground up. We're going to give you the tools to understand exactly how this wild financial ecosystem actually works.
Here's what we've got on the agenda for today. We'll kick things off with leaves, taxes, and inflation, then move right into the monkey debt trap, explore investing versus aping, pull back to look at jungle macroeconomics, and finally wrap up with financial bubbles and crashes. Let's dive in.
Starting off with Section 1, Leaves, Taxes, and Inflation, the daily grind.
So the crucial point here is what we call the rich monkey illusion. Picture this. You clock in, do some honest work down at the banana farm, and earn 100 leaves. You feel rich, right? But wait, thanks to progressive tax brackets, funding things like monkey roads and jungle hospitals, you only actually keep 80 leaves after the monkey government takes their cut. And sadly, that is just the beginning of your money losing its power.
See, there are 4 engines of inflation that literally rot your purchasing power and turn a 1-leaf banana into a 5-leaf luxury. First up is demand pull. Basically, everyone suddenly wants bananas. Then there's cost push. Maybe a drought hits, so fewer bananas are available. Third is production cost. Things like fertilizer get super pricey. Or finally, monetary inflation. The monkey government just prints way too many leaves.
But hey, what if the price tag stays exactly the same? Well, to hide rising production costs, those big guerrilla corporations use stealth inflation. You probably know it better as shrinkflation. They might charge you that same single leaf, but they hand you half a banana peel. Or even worse, they magically rebrand the exact same leftovers as a brand new premium product. Sneaky, isn't it?
And it gets crazier. If monetary inflation is left unchecked, it triggers this terrifying hyperinflation death loop. The government tries to fix high prices by printing more leaves, but that just makes prices double daily. Before you know it, you need wheelbarrows full of leaves just to buy a single piece of fruit. Eventually, the currency becomes so utterly worthless that the government literally burns the leaves and switches to using sticks as the new money.
Which brings us to Section 2, the monkey debt trap, borrowing from the monkey bank.
Because leaves are constantly losing value, everyday monkeys end up turning to debt just to survive. Did you know the literal translation of the word mortgage is actually death pledge? It's a 15 to 30-year loan just to secure a banana house. And it's not just houses. Monkeys also take on massive student loans to learn big-brain words at university, essentially signing up for a second death pledge that makes them want to stand up and scream, "I declare bankruptcy."
To cope with all this, monkeys turn to credit. If your credit score is above 740, the monkey bank trusts you with a leaf card. But you've got to beware of the daily compound interest trap. Let's say you carry a balance. An unpaid 2% charge sounds tiny, sure, but because it's charged on your new, higher debt total every single day, your debt continuously snowballs completely out of control.
So, to calculate your true net worth and actually escape this trap, you absolutely must understand one key difference. Assets are things you own that grow your wealth, like banana stocks and real estate. Liabilities, on the other hand, are debts you owe that drain your wealth, like those leaf cards and student loans we just talked about. Your net worth is simply your assets minus your liabilities. It's really that simple.
All right, let's move on to Section 3, investing versus aping, the quest for more bananas.
This is where you force your leaves to work for you. This asset tier list ranks our monkeys' options to beat inflation. Up at the top, we've got the supreme safety of S-tier bananas, rare, valuable, and edible. Right below that, A-tier index funds offer really consistent returns, while gold sits comfortably at B-tier as a reliable inflation hedge. Down at C-tier is your highly volatile crypto, and at the absolute bottom, the E-tier nightmare, individual stocks and NFTs, which, let's be honest, are often just hot garbage for the average investor.
When it comes to strategy, there is a very clear winner. Active investing means watching 30 hours of videos, agonizingly stressing over volatile charts, and pretty much panicking every time the market dips. Instead, we highly recommend passive investing into those A-tier index funds. By dollar-cost averaging, meaning you buy consistently with just, say, 10 leaves a week over time, you can actually relax, instead of staying up until 6 a.m. reading corporate bank statements.
Now, the exact opposite of passive investing is what we call aping. This is when you see a banana stock surge and you throw in your life savings without a shred of research, driven entirely by pure FOMO, the fear of missing out. Aping into C-tier crypto might sound super fun with its decentralized blockchains and miners guessing passwords, but it's a highly volatile, rocket-powered roller coaster totally ripe for rug pulls.
So let's say our monkey is doing everything right, okay? They're saving, avoiding bad debt, and passively investing. But here is the catch. None of that personal finance stuff actually matters if a massive macroeconomic shock wipes out the entire jungle.
That perfectly tees up Section 4, Jungle Macroeconomics, Global Supply and Guerrilla Warfare.
Let's look at exactly why the bananas in your grocery store might suddenly cost 100 leaves. Believe it or not, 20% of all global banana oil exports pass through one tiny, extremely vulnerable geographic gap called the Bendy Bit of Hormuz. It's a massive bottleneck. If pirate monkeys or geopolitical conflicts block it, global prices skyrocket instantly, driving up the cost of everything from transportation to the actual plastic wrapped around your fruit.
Then we have trade wars. When monkey land and banana land get into a dispute, they implement what's called ad valorem. It's essentially a percentage tariff used to make politicians sound smart during guerrilla warfare. While governments use these import taxes as a weapon to protect local businesses, it ultimately just forces everyday monkeys to pay much more for much worse bananas.
These supply shocks and trade wars frequently trigger a vicious downward cycle. Picture this: an oil shock hits the economy. Businesses immediately make less profit. So to cut costs, monkey workers get fired. Those unemployed monkeys then spend far less money at the stores. As a result, the gross domestic product drops. This leads us directly into a terrifying jungle recession, where economic growth completely stalls out.
Finally, we arrive at Section 5, Financial Bubbles and Crashes, the King Kong Air Pump.
To really understand a bubble, you must understand leverage. This means borrowing 90 leaves from the monkey bank to make a 100-leaf investment, so you're using only 10 of your own leaves. Leverage acts exactly like King Kong with an air pump. If the banana market goes up, the monkey multiplies their gains and looks like an absolute genius. But if it drops even slightly, the monkey's equity is wiped out and they lose absolutely everything.
Watch how this creates the bubble-popping loop. Let's say the banana price drops slightly. Leverage monkeys instantly lose their leaves. The monkey banks panic and demand their loan leaves back. This is what's called a margin call. To pay the bank, monkeys are forced to sell their bananas all at once. This floods the market, causing banana prices to drop even further, triggering a cascade of more margin calls. It literally turns an optimistic bull market into a devastating bear market in a matter of hours.
And we saw this exact timeline play out during the 1929 Great Banana Depression. The Roaring '20s began with cheap loans fueling a massive leveraged bubble. But in 1929, Black Tuesday hit. Panic selling ensued. By 1931, over 2,200 monkey banks failed because they couldn't recover those loans. And by 1933, the economy hit rock bottom with a staggering 25% of monkeys left completely jobless. Which brings us to today, as we look at the current AI bubble, where big tech companies hand billions of leaves to smart monkeys just for the hype. Even when these bots draw badly, produce fraudulent taxes, and guzzle massive amounts of water, we really have to ask ourselves a vital question. Are we just aping into another debt-fueled trap? Or is this truly the next evolution of the jungle economy? Well, that's for you to decide. Keep your eyes open, stay curious, and thank you so much for joining me on this explainer.